The financing arrangements for Mozal are best observed over two phases. The first phase projected total investment of $1.34 billion, of which $520 million was financed through equity. This represents a debt and equity contribution to total capital of 61% and 39% respectively. The second phase of the project required an additional capital injection, culminating in total historical funding of approximately $2 billion. Of this amount, $1.1 billion constituted internationally syndicated non-recourse debt funding. Incorporating both phases results in a debt and equity contribution to total capital of 55% and 45% respectively. Debt funded included banks, export credit facilitators, and development finance institutions. These lenders came from no less than 6 countries and 3 multilateral development finance institutions. In the first phase, the debt was split into 2 tranches of subordinated and senior debt. The subordinated debt amounted to $150 million, of which $65 million was provided by the International Finance Corporation, and the remaining $85 million obtained from other development finance institutions. Characteristics of the subordinated debt included a rate of interest with a fixed floor and a variable component derived from the total sales generated by Mozal. Now, the repayment schedule for the subordinated capital only kicked in at the beginning of the 11th year of the project. This arrangement allowed providers of subordinated debt to participate in the upside of the venture. The debt arrangements permitted the deferment of both the base and variable interest payment when the price of aluminium fell below a set price. These arrangements meant that the subordinated debt had a quasi-equity characteristic to them. The senior debt of $680 million was made viable by the procurement of insurance from Credit Guarantee Insurance Corporation and the South African Export Credit Agency, totaling US $400 million. And that covered lenders for commercial insolvency and political risk such as expropriation, an outbreak of war, contractual breaches, and currency convertibility and repatriation risks. The remaining $140 million tranche on the senior debt was supplemented by the development finance institutions, including the International Finance Corporation. Now, due to the sponsors' combined experience and their capability in aluminium smelters, they did not make use of external financial advisors. The sponsors built an internally generated financial model, and this was credible to the lenders. It also minimized the advisory costs, and it facilitated rapid progress in moving the project from proof of concept to implementation. The Industrial Development Corporation played an essential administrative role in the administration of over 380 contracts and coordinating the disbursement profiles, as these had to be effected on a pro rata basis across multiple jurisdictions. Chase Manhattan acted as the principal international banker for the administration of offshore bank loans and the related facilities. So the International Finance Corporation's participation in Mozal was driven by a combination of a developmental and also an economic agenda. The financial return that was extracted by the IFC was high, and it correlated to the high risk assessment of the project. The IFC ultimately generated a massive return on this project. And this return was made and accentuated by the fact that the IFC didn't have to share in the risks of the overrun of the schedule. Yet they benefited from the project coming in at below budget. This was an area of contention with the other shareholders, who argued that the IFC was benefiting from risks that it did not take and was accruing a return on the full US 150 million quasi-equity facility, when in fact only 130 million of this facility had been drawn down upon. Other questionable characteristics of the IFC participation included the high level of bureaucracy. They had many technical advisors, and they had onerous transparency and disclosure requirements. In summary, the debt raising was a difficult process, exacerbated by the number of parties involved, but without the IFC, the funding for Mozal would not have reached financial closure.